A member of my community recently asked me to do an analysis on Grab Holdings. And Grab Holdings is a company that engages in the provision of super apps in Cambodia, Indonesia, Malaysia, and other countries in Southeast. It operates through four different segments, which are deliveries, mobility, financial services, and others. And through the Grab ecosystem, this single platform with all these super apps for driver and merchant partners consumers, it allows access to mobility, delivery, and digital. Now, in this video, we're going to go through the business moat and model. We're going to look at key financial highlights, the risks and headwinds this company faces, and then we're going to do some of the financial metrics. Finally, look at the valuation. So, as usual, if you like this content, please like and subscribe, and let's go straight into this video about Grab Holdings. Now, looking at their chart, you can see that in the lows of 2022, they reached around $2, a little bit above $2, and they've had a nice run up since then to about $5 and some change right now. And they reached a high of around 663 in October of 2025, but they've pulled back since then. So right now they're trading around $5. So looking at their presentation and documentation, one thing stands out very clearly, and that is the founders want to empower economically the everyday people, the everyday merchants that use their platform. So here they put it into the Grab way since the foundation of the company, and they are empowering other types of merchants to deliver their services and products to the people who need them. It's a very similar business model to Uber, where they're using an app to connect merchants and customers. So whether it's food delivery or some other type of delivery, they're using the app and technology to bridge those people together in a more efficient way. And of course, this means that a lot of the headwinds that Uber faces, Grab also faces in the same way. So, logistics, any type of technology glitches, autonomous vehicle deliveries. So all of that can be also a problem to Grab, or it could be a boon in the delivery system. But looking at fiscal AI, you can also see there's several other headwinds that Grab particularly faces. They're so much smaller than Uber, for example. So if you look at what the bears are saying, the major sentiments are that the delivery business competes with several other peers with low profitability in the industry. There's legitimate questions about the roadmap that the management is suggesting on the profitability of the financial services business and its weak market positioning, possibility of bigger conglomerate with massive war chest, and we'll look at the financials of Grab in a little bit as market entrant if capital allocation is not an issue to new competitor. So this is suggesting that Grab Holdings, the management of Grab Holdings is not really taking into account capital allocations to shareholders as a priority in their business, which is really concerning. So that will be a major headwind. And if a company comes in with a much larger balance sheet, with a much larger market cap, they could easily disrupt Grab Holdings in that area. But then let's also talk about what the bulls are saying. Bulls are saying Grab operates mostly in emerging markets, which should see a larger growth than Western or developed economies. Above average GMV, which is gross merchandise value growth in the short to midterm relative to developed peers. 70% of Southeast Asia's population is either unbanked or underbanked, which facilitates growth for Grab's financial services business, which is good to that segment of their business. The mobility business has no major competitors, which could facilitate continued robust gross merchandise value growth. And that's what the main metric is for Grab Holdings. You want to look at their GMV growth, the amount of merchandise value that is being moved. So you can see that there's both bear and bull cases for Grab. Their model and business model is strong. It's a good business model because they operate a technology app business. But there's also severe concerns about management's roadmaps. There's really concerns about their low profitability in the industry. And there's real concerns about how management is treating capital allocation. So that leads me into their financials. Let's look at their financial history before we get into the recent earnings. So total revenues seems to be increasing nicely. They were negative in 2019, but they've gone up into the right since then in terms of their revenues. Last 12 months sitting at $3.229 billion, which is amazing. Now we have to look at how much of that money goes down to the bottom line. Let's look at their margins. The gross profit margin is staying steady for the past few years, around over 35% to 43%. Let's look at their operating margins. Operating margins tell a different story. It was negative until recently, and it's only recently that they've even pushed above 0% in operating margin income. That's concerning. It's only 0.5%, really low. They've just turned the ship around, but it also looks like it's plateauing, which is also concerning with this company. So that means very little of the total revenues of that 3.229 billion last 12 months is coming down into profit for the company because of expenses, because of, let's see where that is falling off. The cost of sales is 1.837 billion, so a lot of it has already gone right there. Gross profit is 1.392 billion, so they're losing some in between that. Of that, they're taking about 849 million for selling, general and administrative expenses, and then another 430 million for research and development expenses, and then some other operating expenses at 151 million. So all in all, they're inefficient with their revenues coming down into operating margin. So their operating margin is sitting at 0.5%. That's not great. So let's look at their diluted weighted average shares outstanding, see if they're doing anything with their share buybacks or anything. And you can see that they're just diluting their shares here. It's going up. It's leveled off a little bit, but it's still going up. And that's not what you want to see. This must be from either offerings or stock-based compensation. So that's not really good either. Look at their total shares outstanding. Yeah, it's not going down, and that's what you want to see as an investor. If your shares outstanding are going up, if you own the shares of a company as an investor, you own a piece of the company. Your piece of that company is getting diluted if the share count goes up. And so that's what we're seeing here. It went up from, in 2021, it was 3.742 billion. And now it's 4.087 billion. So there was a huge dilution event from 198.5 million to 3.742 billion between 2020 and 2021. This might have been to raise money because they weren't profitable at that time. So that is not great. And it's stayed pretty high ever since then, and it's higher. And just to stay on this topic, their EBITDA has been negative all up till the last 12 months, where they posted about 180 million in positive EBITDA. But they're still very, very immature company, I would say. Looking at their balance sheet, their cash and cash equivalents, let's look at that over time. They're sitting on about $3.28 billion in the last 12 months of cash. That's great. And their total current assets are $8 billion. Let's compare total assets to total liabilities here. And they have way more total assets than total liabilities, which is amazing. $11.355 billion in assets and only 461 million in total liabilities. That's awesome. Their total cash and cash equivalents is 6.927 billion, which is totally a lot more than their liabilities as of the last 12 months. So we really have to look at this retained earnings number. It's sitting at $17.64 billion, and it's only increased over time. So looking at this, it's getting more and more negative, and that means that Grab Holdings was sitting on a lot of losses from years past, and that they could be reinvesting a lot of that into a high growth business. But high growth also means high risk. So investors should really watch this metric, retained earnings metric, to see if it keeps going negative. Eventually, when they become more profitable, they should be going up and closer to zero and then turning positive over time. But yeah, investors really need to look at this number. Looking at their cash flow sheet, you can see that they do repurchase some shares. In the last 12 months, they did about $311 million worth of repurchases. Their free cash flow for the last 12 months is about 181 million, which is pretty good. Their unlevered free cash flow is 181.5 million. And finally, let's look at some of their ratios here. They have about 4 billion shares outstanding, which is an extreme amount, and that came through a dilution event, probably to raise money for the company. Their market cap is around 21 billion, so it's not a small company. I consider anything about below 5 billion about a small. Enterprise value about 14.484 billion. Their buyback yield is 1.4%, which is nothing really. Their debt paydown yield is shareholder yield is about 1.6%. Looking at their PE, it's astronomical at 128.8 for the last 12 months. And looking at their PS, their price to sales, 6.5. So since this company is only just turning profitable, the PS number is probably more accurate than the PE number for them. So PS number, price to sales number is 6.5. The forward valuation, so price to sales comes down, that's good. The forward PE comes way down, that's great, 20.6. Forward earnings yield, 4.9. So the forward numbers look much better than the trailing 12-month numbers. Margins, gross profit margin, 43.1%. Operating margins, horrible, is 0.5%. That's to be much, much higher than that. But they're reinvesting a lot of money. They're in R&D, in SG&A, and stuff like that. So it's understandable, but also it needs to be much higher than that. EBITDA margin, 5.6%. Net profit margin is 1.8%. And another thing about the operating margin, this EBIT margin of 0.5% is going to show up in the valuation, in the DCF valuation. And it's going to make this number, the true value of this company, very small because this is such a small percentage. So I've pulled up their investor presentation here. Q3 2025 financial highlights. Revenue was positive 22% year over year, 17% year over year constant currency basis. On-demand gross merchandise value, GMV, is positive 24% year over year, which is a positive 20% year over year constant currency basis. Adjusted EBITDA is 136 million, and it's up 51% year over year. And trailing 12-month adjusted free cash flow is 283 million, which is up 185 million from the year ago. Financial and operational highlights. They're spearheading the autonomous vehicle adoption and remote driving in Southeast Asia. They got autonomous shuttle buses. Strategic partnership launched in July this year. WeRide, autonomous service investment and strategic partnership in September of this year. And they have global AV partnerships and minority interests in 2025 with various companies. Their financial and operational highlights, their deliveries, GMV, and MTU growth has been increasing. So we saw 22% and 17% in GMV and MTU respectively. And both of those percentages have been going up over time. Financial and operational highlights, the mart growth outpacing core food deliveries. This mart grocery growth is outpacing that. So 10% mart GMV penetration as percentage of deliveries GMV, 1.5x higher year-over-year GMV growth. 13% food MTU adopted our mart offering, and 1.8x higher average order frequency of food and mart. So this is their banking segment and their total loans dispersed in US millions. So it's up over 56% year over year. And that's really cool to see that their banking and financial services is increasing. Eventually, this could be a big portion of their revenues and earnings, hopefully, that it could be high margin. They can get this going and scale it correctly. Loan dispersals accelerated sequentially to 56% year over year, reaching an annualized run rate of 3.5 billion, attributed to ecosystem lending and higher lending volumes, bank and bank. So 90-day non-performing loans remain well within our risk appetite, with our loan portfolio generating healthy risk-adjusted. So they're still in a comfortable spot. They haven't had any type of crisis that would stress their banking system, their loan system yet. So let's look at the breakdown of their financials, revenue, on-demand GMV, and adjusted EBITDA. This is for the entire group of their segments, and we already went through these numbers, but we break down the segments to deliveries. That was 465 million, which is a positive 20% year over year, 17% year over currency. 3.733 billion, which is 26% up year over year for the gross merchandise value, and EBITDA of 78 million, up 42%. And similarly, the mobility segment also saw 317 million, 17% up year over year, 2.041 billion in GMV, which is up 20% year over year, and EBITDA of 181 million, which is up 21% year over last year. And then financial services, 90 million in revenue, up 39% year over year. Loan portfolio, which is unique to this segment, is 821 million, which is up 65% year over year. That's huge growth right here. So they're really scaling this segment up. And segment adjusted EBITDA is negative 31.4%, which is down 8% year over year. Let's look at the incentives that Grab is offering to consumers and partners so that they can scale and grow their business. The partner incentives was 164.5 million in deliveries, 97.9 in mobility, 0.3 million in finance. So they spent a total of 262.6 million in partner incentives alone, Q3. Then consumer incentives was about 321 point. They're spending a lot of money in incentives to grow their business aggressively. Total incentives came in at $584.5 million. That's up from $462.5 million in total incentives in a year ago. And as a percentage of GMV, that is 4.5% in partner incentives, 5.5% in consumer incentives, and a total incentives of 10.1%. And that's up from 9.8% of total incentives a year ago. Finally, let's look at their guidance. 2025 revenue guidance, they're putting at 3.38 billion to 3.4 billion, 21% to 22% year over year. And that is up, so they're guiding up their revenue. Previously, it was only 19% to 22%. And their 2025 adjusted EBITDA guidance came in at 490 million to 500 million, 57% to 60% year over year, which is also up a lot on the lower side, which was previous was 47% to 53%. So let's look at the DCF valuation of Grab Holdings. I input Grab into the spreadsheet, pulled in the automatic shares outstanding, current price, total shares, total debt, and it output the fair value through this. And I want to note that the EBIT margin is super low. It's about 0.8% in this based on the base year 0 numbers, with a book value of about $6.264.7 billion. We're using a beta relevered to 1.32. They're in the software system and application because they're technology app industry. Putting all of that in, we're getting a fair value here of $2.13. So that indicates that the current price is overvalued and there's a premium of about 53% on the share price right. That's just with these assumptions using an FCFF or unlevered free cash flow model, which is taking into account the whole enterprise value. And the primary reason that it's so low is because their EBIT margin is so low, almost zero. So for them to get a better intrinsic value, they need to become more operationally efficient or spend less, which they probably won't do as long as they're growing and in this fast growth, high growth startup phase. So this number is probably going to stay low until they are more profitable and grown more and scaled more. What am I doing with this stock? For various reasons that I've seen through this analysis, I'm going to avoid this stock until I see better EBIT margins primarily. They spend so much of their revenue on SG&A, on R&D, and incentives that I think it takes up most of their revenue, and they're just basically eking out a profit from that high growth and scaling. Not to say that they're not going to do well in the future. I think I like their free cash flow. I like their growth. I like all the numbers that I saw in their growth from year over year. But this is a company that has a high level of risk, just also geopolitically and where they're located in Southeast Asia. It's not an American company. I'm going to avoid this for now, and I'm going to be monitoring it to see their EBIT margins increase in the future quarters. That's it, guys. If you like this content, please like and subscribe, and I'll see you guys in the next one.